Hey guys, Freaky Finance here. Last week we looked at American Hotel REIT, part of our vaccine recovery play that we were expecting. And this week we're going to look at another recovery kind of play with the KEG. The KEG, as you can tell by the picture, is if you guys aren't familiar, it's a steak restaurant. Fairly higher end, I guess. It's $50 a plate for point of reference. And there's about 107 locations. Has quite a few in Alberta, quite a few in Toronto. I want to say 40% in that Ontario and Quebec area. And then it also has expanded into Dallas and Arizona. It has a good footprint and some pretty good locations across Canada. I went and looked through just a few of them just to see where they are. Some of them are just in random spots, but some of them are in nice spots. So with this KEG, you're not investing in a restaurant, which in my mind is a good thing. So this is a royalty stream. And what this means is that you don't have to care directly about, say, spoilage, minimum wage increases, food inflation, a whole list of things you don't have to worry about as a royalty stream. And that's because you're basically just getting 4% of the sales of the all the KEG restaurants. So how I would view this is, so you have the KEG, the business, like the actual restaurants, and then you have the revenue stream, which we're thinking about investing in. The KEG restaurants have all these expenses that I kind of just went through really quickly. So they have the labor, actual food costs, and all that, right? And how the royalty is set up is that it doesn't care about that. Well, it'll care if the restaurant's got a business, but it doesn't really care about how the franchise or the owned KEG is run. It's literally 4% of the sales are peeled off into the investment trust or the income trust. So really this 4% is an expense for this company, but it's our revenue for this company. So basically, before COVID, management, they're expecting sales to increase 4% due to 2020. And for a restaurant, it's actually been growing fairly well. I'm not a big fan of going into restaurants, but obviously there's a reason this time is because they're cheaper, because they've been slammed by COVID. When I go through this, I can see they're growing okay. And one of the things I like about just a pure percent of sales royalty is that you're kind of hedged with inflation, right? So if inflation increases, the restaurant's going to increase their prices, which means your royalty is going to be almost like an index to inflation. So I like that idea with this, because at the end of the day, I think with every government printing money, you're eventually going to have inflation. Because deflation is too poor of an outcome for most people to tolerate. That's my view. So I like that. This page is just saying what they expect their growth rate to be and what it is net of inflation. So 1.2% a year. So it's not a huge growth story. You're not buying this to take over the world with KEG. You're literally just buying this for the steady income stream. So its structure will last for 99 years. So a pretty solid partnership. I'll go into some more details in a little bit, but again, it's just 4% of the gross sales of KEG restaurants in Canada and the US. So we've talked about REITs, but we've never talked about specified investment flow through, or a SIFT, and they're not the same. So I guess how I could explain a SIFT is that, so when I talked about, I guess I'll just keep the example. So you had the restaurants, and then you had our investment trust that we're thinking about buying into, or our income trust, or our SIFT in this case. So this SIFT, basically what was happening, say, before the Great Financial Crisis, is that the 4% that they pay to the SIFT through the royalty was a deductible expense for the corporation, the actual KEG restaurants, right? Because literally it's an expense for them. So they would be able to deduct that as a business expense, and then therefore not have to pay tax or less tax because it was a business expense. On this end, what we could do is take the revenue from the 4%, and what they're able to do after their running expenses is pay the distributions to us and to the other partners. And so what would happen before the government caught on is that they could use the distributions, they would use that as a tax deductible expense. And so what would happen is that the trust itself, the SIFT itself, wouldn't pay tax, because you take the revenue and just after your little expenses for running it, you'd also just have all your distributions, and you just pay out the full revenue amount in distributions, and therefore not have to pay tax at the trust level. So the government caught on to that, and they basically put an end to it. So they said, nah, your distributions don't count as a tax deductible expense. They caught on to that, removed it, so now SIFs have to pay a trust tax. For good or for bad, it made SIFs less attractive. So it doesn't have the same tax, and that's kind of like a recurring theme. You're going to see things spring up in the tax code, and then the government slowly close in on them. This is just another example of that. So the income distribution, it was actually paying a pretty good dividend and fairly steady pre-COVID. And you can see it going from 9 cents a month, so quite a lot, to 3.5 cents a month. They cut it quite a bit, but then recently they added it, and that's what made me look at it, because I was like, okay, obviously management is comfortable paying more because business must be starting to resume. And so that's when I bought into it. Obviously most of the return was from last week during the vaccine results that we were expecting. You can see that it's been hammered quite a bit, but relative to the low, it's already off the low. So I got in at 8.32, but I'm planning to hold this one probably till it goes back to $14 or $15 a share. So for context, so on this chart you can just see the effect COVID's had on it, and it was growing. Like the KEG has been growing, and shareholders have been getting rewarded, and the distributions have been rather high. So it made a lot of sense for a lot of people to hold it. And then COVID happened, and the market said yikes, and obviously the dividend got slashed by 2/3. And so we started to bounce back. Another reason why I started looking at this one was because I listened to the Texas Roadhouse play. Same kind of idea with the steakhouse. I'm a little bit different, obviously, because in Canada it's colder. So you can't have the same kind of patio you can in the spring and summer. But I mean, you're not doing that in November. This is kind of the upside play over time as a vaccine continues to roll out, and this royalty stream, assuming KEG doesn't go under, obviously, will just keep paying a steady dividend when you just wait for the appreciation, and then the dividend also increases with the business coming back. Obviously, there's a couple negatives that we're going to talk about in a second, but first I want to go through how it performed year over year. This is annual pre-COVID. The balance sheet, so with a SIFT, is actually very simple business. There's not a lot going on, so I don't have to spend too much time. I didn't have to write down anything in Excel this time. There's not a lot of assets. They have their KEG rights and tangibles, which for my purposes doesn't mean anything. And then you have the current liabilities, which is really just the distributions and tax that they're liable for. So when they declare dividends, the liability. When they pay tax and they haven't paid it yet, it's liability. And they do have these two types of partnership trust units, and that's important on the liability side. So how it's working is that the Class C shares and these exchangeable shares, basically just view them as they're getting paid the distribution before you are. So that might suck when they're cutting the dividend, but usually it doesn't matter. It mattered this year, but usually it doesn't matter. This is just how they performed last year. So you can see fairly steady top line. So royalty income, almost 30 million. Divide that by 4 and you're getting 7.5 million a quarter. And basically, profit before distributions is very similar. Like it costs $1 million to run the fund, basically. And then you can see here distributions recorded as interest. So you can see the other partnerships getting paid. These are the other two guys. They're peeling off their 11 million profit before fair value gain and income taxes, 17.5 million. And then this is the noise part. So that's just their fair value profit gain and loss. The real number here that I look at is this one, and then obviously they pay tax on it. So overall, it's a fairly stable company, usually. And so that's why I was able to pay a nice steady income. When I go to their Q3, so this is latest numbers, I think came out on Friday, so today is Saturday, November 14th. You can see restaurants and royalty pool 106, and most importantly, you can see how it went from 155 million in the pool in sales to 142 million. And then you had April, May, and June. Canada had some pretty harsh shutdowns for restaurants. This thing got smoked in Q2, and you saw the stock market react. You saw the management team of the SIFT reduce the distributions, which is what you're supposed to do because you can no longer have the income to pay the distribution. But more importantly, you can see the rebound. So Q3, you can see the rebound. We care about this number, the 106 million, but that's not ours. We only get 4% of sales, so we care about this number. One of the things that's nice about this trust is that you also get this interest income, and that's from the other partners. So they just have this structured. I'm not going to go through it today, but they have a structure. Basically, you got this kind of like steady $1 million a quarter. Total income's this. Still costs a little bit of money to run the fund, 200,000, and then distributions to the other two partners, and the number we care about. You can see starting to come back. Looks pretty good. Obviously, that's why management started increasing the dividend. I do want to point out here the payout ratio is still very high, so you are at risk if there's another shutdowns. They might just peel back the dividend again or stop it completely just to wait it out. I think this company, assuming obviously KEG restaurants keep operating, it should be fine in the long run. I think this is the last big shutdown event before a vaccine rollout, right? So as long as their company can make it, in this case it's the royalty, so really you're just hoping all the normal restaurants can make it through COVID, and then you're laughing. But yeah, you can see the effect COVID has had on it, right? Going from 6.7 million for us to 1.8 million in a quarter. That's a big swing, and then coming back up to 5.3 million. So starting to normalize, but there is some headwinds. Obviously, that's why, well, the share price has rallied because of the vaccine as well. The market's trying to start pricing in a recovery in this finally. I do want to point out this is Q3 as well, just for the cash flow statement. So normally I spend a lot of time on the balance sheet and the income statement, but there's not a lot there, right? It's a very simple company. There's no COGS or margins or anything like that we have to worry about. It's really just the royalty, 4% of sales, and then you have the cost of running the fund, and then you have the distributions, so, and then taxes. So anyway, you can see the cash flow from operations. That is important. Still taking a hit year over year. For the financing side, you can see the distributions to the three types of shareholders in our partnership. And this one would be me and you. So we're this guy. So year over year comparison, or year to date rather, for 9 months, you can see we've kind of got halved in our distributions. That's kind of how management has dealt with a decrease in sales, by decreasing the distribution. So for this, for our purposes, if there's another shutdown, you can see the distributions go back down again, and then we just ride it out until the vaccine roll out, and then the business will come back like it just has. So proof of concept's there for the investment thesis, and then you just ride it up. So that's kind of what I'm thinking with this one. Again, I do want to point out that technically the dividend it paid is higher than its cash inflow. It's not a big deal. I mean, it was basically, the Q3 was fairly good for our purposes. I mean, it only went down 70 million, and they have enough cash in the bank to cover that for quite some time. Not a big deal for now. It could be a headwind with our Q3 numbers, or sorry, Q4 numbers. As you can see, the subsequent events here, you can see Quebec announced a shutdown October 1st. That will affect our Q4 numbers. Ontario did a shutdown October 10th, or October 9th rather. That will affect our numbers. And then Manitoba, I think they only have like 4 stores or 3 stores. But again, so things are shutting down. Q4 might look worse than Q3. It should, based on this news. But we'll have to see if that's the better opportunity to get in again, right? So I'm looking at this company. If people freak out during the shutdowns again, like they did, say, in March, I'm going to buy this probably more aggressively than my current position. And if it stays like it is, I'm just going to ride it out anyway with my current position. So that's how I think about the KEG. I mean, for all I know, this company, right now, it's down 40% year to date, which doesn't sound, maybe it is quite a bit, right? So, but we know the business proof of concept can come back as long as the governments don't force the shutdown on them. I mean, they're not shutting it down to be mean, obviously. They're shutting it down for health purposes. But that's the investment thesis. So slightly, you might get some more pain, better opportunity to buy it, and then you just ride it up again, just like we did. Obviously, the next time we're going to have vaccines and a real light at the end of the tunnel. So you might get this, not the same kind of down move, not to like the $5 level. But I mean, if they slash their dividends again, say to nothing or back to where it was, 3.5 cents instead of 5 cents, you might get a better opportunity to buy again. So I have this on my radar to add in, to average into, if there's a freak out with this incoming cases. But obviously this week was very good for our recovery plays. But I'm looking forward to this company normalizing over time. I don't think I'm going to hold, I don't like holding restaurants forever. So this is really going to be a recovery play for me. I might just ride it, collect the dividend, and then once it gets back up here, I'll probably try to move the money to somewhere else. But that's the thought on the KEG. It's a pretty solid SIF model. I mean, it's an income stream from the sales, right? So honestly, an investment thesis, if you had to wrap it up in one line, it's, you think the KEG sales are going to increase or decrease? And if they increase, will the dividends increase with it?